And joining me now for a closer look, what is playing itself out in that market scene is Gary Booysen from Rand Swiss. Gary, a pleasure. Happy Tuesday to you.
Yeah, happy Tuesday to you too.
Brilliant. And not a bad day on the JSE, a very busy one from a sense perspective. Maybe let's start off by just trying to understand what markets are trying to take stock of this afternoon.
Yeah, so it's a fairly benign outlook, as you're saying. So we look across the European markets, kind of up, between 1/10 of 1% and probably a quarter of 1%, across the different countries. Our local market really tracking the same. The resource index up almost 1%, but financials lagging slightly, but also green, and our overall market up about 1/3 of the percent. And all of this, you just get the sense that the market is treading water ahead of an incredibly large set of results tomorrow, which is of course going to be the Nvidia results. We also starting to see, I suppose, some tension just creeping into the market around the Chinese-US relations. Kind of front page of the FT this morning. The idea that China is going to curtail some of the supply of its rare minerals, germanium, gallium, which are crucial in the components in the construction process of semiconductors. Citing national security concerns. At the same time, over the weekend, we've seen a flare-up in tensions across the Middle East. So you've got that kind of bubbling under the surface, but everyone's saying, wait a minute, kind of business as usual. Let's see what happens with obviously the big Nvidia results out tomorrow. Can this, I suppose, tech and AI-driven rally continue? And then, of course, it's also the counterpoint to the kind of rising geopolitical tensions is the idea that we are going to get rate cuts. So we've got the optimism around Jerome Powell's comments filtering into the market. I look at what's happening in the Fed funds futures, and in the next 4 meetings we're pricing in 1.25% worth of cuts. So that's saying at least 25 basis points every meeting, and one meeting at 50 basis points. So that's obviously driving a lot of enthusiasm, cheaper money, obviously boosting asset prices as well. So even though we do get this sense that there's a little bit of pessimism around, that's just being washed away by easier monetary policy. And then, of course, a couple of stock updates as well, and I suppose the PCE numbers on Friday, which is going to be the Fed's preferred measure of inflation, also just sitting in the back of everyone's mind. So trading water for now, waiting for a lot of big events to come up later in the week.
I want to chat about Nvidia, Gary, because of course, one of the things I've read just leading up to the set of numbers being released is markets will be they'll be shaken by anything less than eye-watering growth. It's what really we're trying to see here, and I'm wondering if we're not setting ourselves up a little bit for the volatility that we're clearly seeing in the market.
Are we setting ourselves up? I think you have to look at. I think there's a lot of expectation baked in, but it's expectation that has been delivered on over the last couple of results, and that's really the key factor here. A lot of clients ask us about this. A lot of clients are looking at Nvidia, looking at the absolutely parabolic returns that have been achieved, and saying, surely this is the time to exit. Surely it's run too hard. The problem is that the underlying revenue of the business is intact, and it's really the expectation set by management is there. So we are expecting a very good set of results. Now, of course, if we don't get the set of results, I mean, markets are going to absolutely panic. You get a sense a lot is baked into the price, but at the same time, they have been delivering on this, and it does look like the demand for their chips and their product is just unlimited. And from that point of view, as long as they deliver in line with what they've promised, I think you can see even further share price rally. But it's obviously going to come down to what do they manage to deliver tomorrow, and that's it's going to be key. And unfortunately, it's going to have a knock-on effect to the rest of the tech sector. The tech sector, a huge component of the likes of the S&P 500, and anyone that's holds these trackers. So you get a wobble in the tech sector, and you're going to see a lot of these index products falling aggressively. And I suppose one of the trades that we've seen from a lot of clients at the moment is to try and broaden their exposure. If they've got this kind of big, large tracking kind of exposure to big tech, they've been spreading into things like the Russell 2000. They've been looking at other geographies as well, looking for those obviously those pockets of value to try and insulate themselves against a broader tech sell-off.
Very keen to then also get into some of the stories out today or updates out today. Pick n Pay, I think the big one here, we are still seeing Pick n Pay battling. Apparently, it's going to get worse before it gets better. I'm wondering where markets are in terms of that worst curve? Have we peaked here? Have we seen the worst of it, Gary? Or, could we still see some more downside here? Of course, aware that the execution risk where Pick n Pay is concerned is very high.
Yeah, I think that's it. There's a lot that can go right, and I don't think that the stock is priced, particularly aggressively for a turnaround. And we've got to remember that Sean Summers and the management team took over in March 2024, so it's been a fairly short time that they've had to make a lot of adjustments. But there is a massive task ahead of them, and of course, with financial instruments and financial market pricing, if they get it right, I think there could potentially be a lot of upside in Pick n Pay. I think there's a lot of skepticism from market participants, though. Pick n Pay has been promising this turnaround for decades, and we haven't seen it. But as I said, the stock is not particularly expensive, given the road ahead, and what the potential result is if they get it right. So there were a couple of this was a 21-week trading update. There were a couple of highlights in there for me as well. So yes, they closed 16 stores over the period, which did hit their same store sales number. But that's what you want in a turnaround. They're closing underperforming stores. They're taking the difficult decisions now to put the group on a better footing going forward. Obviously, they've concluded the 4 billion rights offer successfully, so the balance sheet is looking in a lot better position. Of course, the next step in the recapitalization process is going to be the IPO for Boxer, so definitely looking forward to that and the fanfare around the listing of Boxer that we'll have at the exchange. But yes, online sales also growing nicely. Again, online sales is a very difficult number to have a look at. Pick n Pay ASAP will be to an extent cannibalizing some of the more traditional store sales. Maybe not people not stopping off and doing that trolley or basket shop, but instead using the online app. But definitely, as we've seen from the likes of ShopRite, getting their technology and their delivery system and their online sales right is absolutely critical to competing in the South African grocery market. And then looking at Pick n Pay Clothing as well, they are gaining market share in Pick n Pay Clothing, which is fairly positive. But as I said, a lot of work to be done in the company. The group sales figure was not good. I mean, we're talking about 4.5% increase in group sales. If you look at the like-for-like number, you're talking about a growth of 3.7%, which is kind of below inflation. So I mean, not a lot to write home about, but I think an interesting company to keep an eye on at the moment, just given the pricing. Market didn't particularly like the update, so they, in a day which I said is fairly benign, we've got everything up a little bit. Pick n Pay is down almost 2%, so market certainly punishing that. I think maybe hoping for a little more at this stage, but of course we're going to get that when they release their full results.
Keen to get into some stock picks now, Gary. Let's start off by taking a look at counters that have found favor with industry peers.
We're going with Santam. It's really a geared investment trust, largest insurance, short-term insurance group with a very large investment in bonds and cash and equities through their free float. So the underwriting cycle looks like it's turned. A very good trading update. The share has appreciated, but you're getting sort of a geared investment in the domestic equity market. So it looks very attractive, particularly if we expect equities to continue to run in South Africa as we do.
Going for Growthpoint. It's been unloved for quite a while, and that's because it has about 50% of its portfolio exposed to the office space, and we know office hasn't recovered from COVID. But I think as we move into this rate cutting cycle, you're going to see their strong retail portfolio like the V&A Waterfront, which they have, being complemented by a recovery in offices as the SA economy surprises to the upside, which we think it will. And so you'll see a re-rating and in Growthpoint.
I'm going with AVI. AVI is a consumer brands company. They've got some well-known brands like Baker's Biscuits, Five Roses Tea, Green Cross Shoes that they own as well. And, for them, they've managed this price volume dynamic very well in terms of making sure volumes don't drop off quite significantly by lowering the prices, but then also not lowering prices too much so that their margin gets impacted. I think going forward, we're going to see some softening of the input prices, which would be beneficial for their overall operating margins. And again, it's a company that's very well managed, well run, and they do pay out quite a generous dividend. And every 2 years or so, you do get a special dividend on top of the ordinary dividend. So a good total return from a cash flow perspective for the investor. And again, I think the environment is moving in their favor from a consumer discretionary perspective.
All right, Gary, we have Santam, Growth Point, and AVI. Any one of those stick out for you?
I like growth points on those. So I think looking at Santam, I mean, the share price rally has been absolutely exceptional. So I might be a little bit concerned about buying in kind of just from a technical point of view. You've almost had a spike. You want to see that pull back a little bit before you enter. Also, if I look at kind of projected revenue out for 2-3 years, I mean, it's fairly flat. Although you are expecting 2 years out, it's double-digit earnings growth. So that's at least positive on Santam's view. But the idea about buying growth points, I had a look at the property sector yesterday morning in quite a lot of detail, and just the listed property space. And growth point, if we look at the 5-year total return, is actually slightly negative. And of course, it's been a very, very difficult period. As the guest was mentioning, massive exposure. Well, not massive exposure. It's about 40% exposure to the commercial segment, so offices. And we've gone through a period of COVID where work from home, and there's been structural changes to that part of the market. But I do get the sense that with falling interest rates, you're going to see a pickup in activity. And looking at one of the diversifiers like a Growth Point or a Redefine that have their split of commercial, industrial, and retail is interesting. And I think it could be primed for re-rating. As the guest mentioned as well, at 9% dividend yield, that becomes relatively more attractive when we see a falling interest rate environment. Typical fixed income products are not going to be paying the kind of yields that we had previously, and yet rentals actually become more stable, and that dividend yield, or that distribution at least, does look like it will continue and give you a better relative return. So I do like Growth Point. It's one that we hold in portfolios, but certainly hasn't done anything as good as Storage, which that, if I look at that on a 5-year basis, is up in total return terms, so including the distributions, they're around 63%, which is way ahead of the JSE South Africa listed property index, which is only up 21% over the period. So I like Growth Point. I think it's an interesting space, and I think the whole area is getting more and more interesting with the idea that we're going to have interest rate cuts going forward. I suppose two other ones that are kind of interesting to look at are probably something like Vukile, also very, very interesting, done exceptionally well, and maybe the Spear REIT as well, which has benefited from the big jump in Western Cape property values.
We don't have much time left at all, Gary. I'm keen to get to your stock pick real quick.
I'm going to stick sorted in the property sector. So I'm going with CoStar Group, which is an offshore company, and it's essentially a data vendor. So traders or people in the market will understand. It's kind of the Bloomberg for real estate professionals instead. So it does all the data aggregation around property prices. They do everything from aerial photographs to historic sales values, and gives basically anyone that's working with buying and selling property access and the ability to make informed decisions. And with the pickup that we predict in the property sector over the next sort of 2-3 years, and with the increase in real estate activity, having a real estate focused data vendor is a nice entry into the market without taking on direct property risk. So we like it. It's offshore and it's not expensive at the moment.
Well, Gary, an absolute pleasure having you with us today. Thank you so much for taking us through the markets this afternoon. That was your Midday Markets Update with Rand Swiss's Gary Booysen.